Welcome everyone to our monthly Innovation, Knowledge and Inclusive Development Seminar Series at the Open University. I am Dinar Kale. I'm Professor of Innovation and Development here at the Open University. We are delighted to have an amazing seminar and two speakers with us today to present the second seminar of the 20th seminar series. Our first speaker is Dr. Mustafa Erdem Sakinç. He's assistant professor of economics at University Sorbonne, Paris Nord. He's also head of economic policy and research master program at the US PN, the same university. And we have second presenter is Professor Pauline Gleadle. She's a professor in economics at the Open University, and her research interests in wide different areas, interdisciplinary areas such as economics, psychology, social psychology, and critical management study. They are going to present on value, stakeholders, and financialization, the case of Big Pharma revisited. It's a paper which has a third author, Leonard, who is here as well, and Leonard Kirsten. But the paper will be presented by Pauline and Erdem. The video is being recorded and will be available for playback. So people who don't want to be featured can ask the question in the chat and ask to remain anonymous. You are automatically muted for the duration of the presentation, but please raise your hands if you want to ask a question. We have an X account which we will put in the chat, and it will be, you can follow us to get updates on the events. Usual rules apply. We will have presentation and seminar for 40 to 45 minutes, followed by Q&A. So I hand over to Erdem, who is going to start the presentation. Erdem, over to you now.
Thank you, Dina. Thank you very much for presenting us also. I'm just making it full screen. I think you are seeing my slides. That's okay. Thank you. Thank you so much.
All good.
Thank you again very much for inviting us to your seminar series. I'm very pleased to be here with you today. I'm Erdem Sakinç, assistant professor at University Sorbonne Paris Nord, as Dinar presented. And we are going to present you the results of two different studies that we have been working on. Me, my colleague Pauline from Open University, and our PhD candidate Leonard Kirsten from also my university, University Sorbonne Paris Nord. I just want to pass the word to Pauline, who will introduce actually our papers and introduce our overall framework. Then I will get back and continue with the analysis and findings of our studies. Pauline?
Yes, thank you very much. So moving to the second slide, which I guess you're doing, Erdem. Basically, the paper that Erdem and I wrote together sets out the conceptual framework of what we're looking at in terms of value. But importantly, particularly as we're talking about financialization, we're not talking about value from a shareholder value perspective. Instead, we go to some lengths to operationalize or make measurable a stakeholder perspective and use a demonstration using accounting data from two German massive pharma firms, Bayer and Merck. The second paper, which is still in progress, which Erdem is leading with myself and Leonard, applies the analysis of the source and uses of funds of Big Pharma being, as you probably know, the largest international pharmaceutical companies in the world. So this second paper is going into more depth into the reasons why these firms use external financing with an aim of us understanding more about the financialization of the non-financial corporation. Erdem, could you go to slide 3, please? So what we're trying to do in this paper between Erdem and myself is to understand the linkages between the financialisation of non-financial corporation and the unbalanced extraction of value by stakeholders. As some of you may well be aware, there's been quite a lot of work, but using different frameworks, different data, different time periods, which looks at a stakeholder approach to looking at the extraction of value. And mainly, however, the stakeholders used are capital and labour. Um, However, our paper is somewhat different. It's like a paper by Haslam et al. In 2007, where we use the sources and uses of funds, focusing on stakeholder claims. And why we do this is that we are seeking to avoid as much as possible using cash-based type data rather than profit-based data and balance sheet, which involves a lot of accounting distortions from our perspective. Um, so basically, what we're trying to understand is something about stakeholder conflict in the extraction of value, which is obviously a very different approach to what Ed Freeman uses in his views of stakeholder analysis, where essentially everything is collaborative, which we don't agree with at all. Um, so we have limitations in terms of data liability, which I'll pick up at the very end. But Erdem has always talked about what we're doing in terms of building a bridge between what we can see as pure and tidy theory around research and what is actually happening in the financialization of the non-financial corporation. So we're trying to arrive at something of the dirty and complex empirical reality of what's actually going on in the process of the stakeholder making claims. Um, so we look at multiple aspects of the financial or the non-financial corporation. As you may all be aware, one of the issues around this is that there are many different exact definitions of financialization and many different operationalizations. So that is something we bear in mind. But what we are essentially doing is identifying the changing pattern in the use of funds under financialization and sort of challenging common sense views that firms issue shares and bonds or borrow from banks to finance their productive investments. This is something that Erdem um, knows a lot about, and what he uncovers is that the reality is really quite messy compared with what you would expect. Erdem, can we have slide 4, please? Um, so I mentioned the different definitions, operationalization of the financialization of non-financial corporations, but we're talking about it in terms of financialization as the prioritization of corporate practices favoring financial rather than productive ends and the pursuit of shareholder values strategies. And in using that definition, we're basing this on classic work, Lazonic and O'Sullivan, 2000, Krippner, 2005, and Van der Swan, 2014. So as you can see, there is a lot going on. Similarly, whilst there's much research on financialization, this has shown that inequality, which is something we're interested in, of course, between shareholders, managers, and other employees, has increased since the 1980s. So this is a very common observation about what financialization has helped to lead from. Erdem, Slide 5, please. So once we get talking about stakeholders, we're using the definition of Garriga 2014. We define them as groups or individuals who contribute substantially or not to the value creation of the process. So as you can see, this fits with what we're looking at. Importantly, also, we would make the caveat that within stakeholder groups, they're likely to be winners and losers, and work has shown that this is particularly the case in highly innovative firms. Yet another caveat is that if we look at Samantha Miles' paper in 2017, she has done an extensive study of definitions used and so on, and found that there is very little consistency between definitions of different types of stakeholders, which is something we may turn to later. Erdem, slide 6, please. So having said that stakeholder itself is a somewhat different definition, value is the same. Like stakeholder, it's widely used in both the economics literature, also management studies and strategic management, and by mainstream and critical accounts, but again, with very different interpretations. As I said earlier, the most commonly and controversial use of value is probably shareholder value, which tends to refer either to its creation or destruction as part of financialized strategies followed by NFCs, non-financial corporations. However, our perspective, being non-mainstream as we see, following work of like Lazonics 1994 and Mariana Mazzucato's 2018, we see value and its creation as a collective process. This is echoed in some of the strategic management literature, so that multiple actors, internal or external, contribute both measurable and immeasurable resources to generate goods and services with the hope of sharing return. So, in a nutshell, summarizing this part where I'm doing the presenting, what we're looking at again is incredibly messy, lots of definitions of stakeholder, lots of definitions of financialization and value. So the question then arises about how do we go about pinning down more accurately what we're looking at. So Erdem, it's over to you now and slide 7.
Thank you very much, Pauline. Yeah, I would like to just continue with the kind of overall framework that we just wanted to build around this concept of value and also just stakeholder dynamics. And this figure provides a summary of our view on the relationship between creation, extraction, realization, and destruction of value. In our just framework, value creation is the result of interactions between human inputs and other separable inputs and assets, and it also includes the improvement in production capabilities that result from experience and learning by doing. So all those inputs you see here in the blue boxes contribute to the value creation process. By value realization, we mean the sale of a good or service to the customer and the generation of income to be extracted later by different stakeholders, or reinvested back to the productive activity. So value is extracted in the form of wages, salaries, interest, dividends, taxes, and all those payments to other stakeholders, either before it is already just realized or after value realization. Extraction is we just think that extraction is an indispensable part of productive activity, as it also creates the demand for goods and services that justifies their supply. And the upper arrows from value extraction back to value creation refers to this fact. Since value creation is an uncertain process and the realization of revenues cannot be guaranteed in advance, and since value extraction is an unequal process due to different bargaining positions, when a certain stakeholder extracts more than its contribution to the value creation process, and as long as this excess extraction is not reinvested back to productive activity, a process of value destruction occurs, represented by this red arrow and the red box. Extracting value today without putting in place new value creation capacities reduces the capacity to create value tomorrow. The destruction of value leads to a breakdown in the delicate balance between the creation and extraction in favor of an uncompensated extraction by certain actors. So we consider that the creation and extraction always takes place in tandem, but we believe that they are experienced differently by different stakeholder groups. This different experience allows us to identify the winners and losers as a group in the processes. It's important to note that value creation in the real world would be best viewed as a collective or social process in which it is impossible to completely isolate value creation from each individual participant. And given the interdependence of creation and extraction, the sustainability of the whole process depends on the extent to which the share of value realized and extracted is reinvested back in the next cycle of productive activity and capacity development. The key is to determine the extent to which the share of extracted value is redirected towards value creation rather than value destruction. And what is often neglected in the financialization research is the conceptual and empirical analysis of the relationship between these processes by different stakeholders in an environment where unequal power relations define the rules of distribution. The financialization of the non-financial corporation should refer to the increased role of financial channels and actors in the extraction and destruction processes. By adopting this value flow perspective, we seek to develop a new global understanding of the non-financial corporation. To focus on our case, we assume that the financialized corporation, in this case, the financialized pharmaceutical company, prioritize financial value extraction and value destruction through a strategy of maximizing shareholder value, which is the motto of financialized corporations over the last 40 years. We hypothesize that in the context of financialization, the reorganization of the allocation of corporate resources in favor of certain economic actors imposes its power to extract and destroy much more value than it contributes to the creation of value. We then examine the way in which the destruction of value dominates for certain companies in our sample, in our second paper, by showing the proportion of funds directed towards non-productive financial uses. I mean, given our point of view, although we draw on the overall stakeholder theory, which emphasizes the diversity of stakes within a company, we do not share Freeman's view that organizations are necessarily collaborative. On the contrary, we consider that the stakeholder theory's normative approach blocks the understanding of the systemic persistence of inequalities, a goal of our approach to understand. And taking the considerations to step further, we argue that it's important to remain also vigilant about the use of language. For example, payments to value-creating actors should perhaps not be considered as expenditure, but rather as compensation or remuneration in order to highlight their contribution. We believe this is important because when labor, generally considered as the essential element of value creation, is considered an expense or cost, this legitimizes, perhaps unwittingly, the neoliberal ideas that these costs, like any other cost must be reduced as much as possible in order to improve shareholder value. So although we advocate the use of cash-based accounting figures rather than accruals, it is also important to understand the nature of the cash flow statements included in company accounts to reveal the findings. I mean, in any case, no version of the cash flow statement shows the contribution and deduction of the various stakeholders to the total value creation expressed in its total income. So to create such a table, at least in part, I mean, not fully, unfortunately, we need to compile data on the source and use of funds and the share of each stakeholder based on various tables and statements provided by the company, insofar as we can find them. Despite the necessary compromises, still the cash flow statement remains our main source of information. In the case of our own analysis, adopting this methodology enables us to observe, at least to the extent that it is made visible in the financial statements, the relationship between value creation and extraction through the choices made by corporate decision makers in allocating corporate resources. So, in our first article, while remaining aware of the limitations of our data, we present a financial flow analysis covering all major sources and spending elements of the two major German pharma companies. To gain a more comprehensive company-level perspective, we aim to explore the relationships and interdependencies of two companies' financial and productive choices and their outcomes for stakeholders. In our second article, which is an extension of the first, we look in more detail at the links between companies' productive activity and financial flows. We classify the incoming and outgoing financial flows of the 27 largest pharmaceutical companies for pretty much the same period. We only just updated the data for the latest year. Through this analysis of source of use of funds, which also helps us to identify different patterns. Overall, we attempt to link the value theory discussed with empirical indicators in a comprehensive and comprehensible also way. Our case is Big Pharma. In our study, we argue that the pharma industry is different from others in many ways. We consider the value creation in this sector to be quite special, as it involves the development of production of safe, innovative, and affordable, preferably affordable medicines. This creation is realized through the purchase of these drugs by the healthcare system or by end users. And this realized value is then extracted in the form of payments to stakeholders for their contribution, or it may be destroyed by those who contribute the least or who didn't contribute at all. Although such an account seems straightforward enough, under financialization, value destruction erodes the productive base of the pharmaceutical industry and can therefore lead to the hollowing out of companies. In other words, this financialization can place a heavy burden on consumers and government through higher drug prices and also massive public subsidies that could be avoided actually through fairer drug pricing and corporate investment in early stage research. I mean, I'm just not only talking about reducing drug prices, but also just reducing those subsidies, I mean, which are just basically just exploding over the last 2 decades. The sustainability of the sector. Numerous studies have asserted that the global pharma industry is suffering from an innovation crisis, due in part to the uncertainty inherent in the pharmaceutical research, of course, but despite the continuing increase in government subsidies and also corporate R&D spending on drug development, despite these inputs, the number of truly innovative drugs in terms of decisive like therapeutic advances has not yet increased in the same proportion. And the contrast between increasing public sector support and growing private control over resources and returns has become more pronounced with financialization. And indeed, during the COVID-19 pandemic period, this disparity between the growing public sector support and increased private control over resources and returns become even more pronounced. In the long term, we believe that a strategy of maximizing shareholder value is unlikely to be viable for the sector at all, unless two conditions continue to be met, like it was the case over the last 20, 30 years. Firstly, governments must continue to increase their funding of pharmaceutical research, plus these expenses. And secondly, consumers must, by whatever means, funded by healthcare systems. We are corporate actors can continue to extract and destroy the value created. And it is in this crisis of innovation that we apply our methodology. I mean, if I start with the first, the strengths and limitations of our methodology, we present in this paper an analysis of Merck and Bayer, two major German pharma companies. The main reason we have chosen these companies as like case studies is that we wish to highlight the mechanism surrounding value creation as described and its subsequent extraction by stakeholders for whom we have the relevant data. For example, I mean, US companies do not systematically disclose employee pay figures in their financial reports. So this is a kind of major handicap for us to just show those similar dynamics in the case of US corporations. I mean, and they are not obliged to show how much they pay in total to their employees. And moreover, another reason of choosing these two companies that their activities have been largely anchored in Germany and its broader corporate governance framework, which explicitly prioritizes the interest of all stakeholders, not just those of shareholders. We wanted to see if, I mean, we can also observe this prioritization in numbers, true numbers of those companies. I mean, although they differ from other large Western pharma companies, particularly in terms of diversification, but they also differ from each other in a number of ways. These include also, for example, Bayer's recent internationalization strategy, the acquisition of Monsanto, etc. So I start with our findings. I mean, here in this table, you see just the breakdown of average sources and uses of funds over the whole 23-year period, which highlights a strong similarity between the two companies in terms of their sources and uses of funds. In addition to similar levels of internal cash generation, like over 60% of the total sources, they just also continue to borrow heavily, more than 20% for each, but notably to finance their acquisitions. But funds generated by divestments are also another important financial source, around 10%, and the remaining just 2% or around 2% is just through share issuance. And in terms of alone are the most significant item, reflecting both which had become the norm rather than the exception among large pharma companies over the past 30 years. And the high level of debt repayments also reflect the fact that they need to realize as much value as possible to repay the loans they have taken out to finance their acquisitions. The funds generated by Bayer and Merck through share issues are also used for acquisitions even, but on a very small scale. Just one difference between the companies is that, the similarities between the two compared to other companies, other large pharma companies in the rest of the world, they have not carried out share buybacks with the aim of maximizing the shareholder value, and their dividend payments are also remained low, about less than 10% of the total uses of their funds. In the second step, and we will also see in our second paper about the situation for the whole sample of Big Pharma. And the second step in our analysis, in our first paper, is to compare value creation and value extraction according to different stakeholders. And this table presents this comparison of average annual monetary figures of value creation and extraction. We consider that each stakeholder contributes to value creation in different ways, through their labor, through their funds, through their just subsidies, etc. And the company's cash flow generated by productive activity after payments made to external actors not mentioned in the table, such as suppliers or partner companies. We claim that they can only be just generated by the workforce in the form of value creation. So this cash flow before those, after payments made to suppliers, partners, etc., but before payments made to those stakeholders that we anyway have in our analysis here, it's just attributed to the value creation by the workforce. Overall, internally generated like cash flow is much greater than payments to employees in the form of wages and salaries for both companies. You see the differences here, like 15 billion to 9 billion and 6 billion to 3 billion. Just only over like 50% of the total like value creation, they just kind of extracted through their wages and salaries. But the remaining can be just assumed that going to actually the allocated to other forms of spending like capital expenditures, acquisitions, and R&D. From a production point of view, these are investments made on behalf of the company that will help determine the generation of future income. And this potential income will in turn be shared back again with by stakeholders. But on the other hand, there's a large disparities evident between shareholders' contributions already in the case of Merck and Bayer. We can imagine what is the situation with the US corporations in this case, but share issues and payments made by companies in the forms of dividends are totally just unbalanced. The total contribution of shareholders is just, or the total extraction of shareholders is just more than 3 times higher than their contribution, or more than 4 times higher than their contribution in the case of Merck. but these two companies are still like kind of the ones representing the stakeholder model. I mean, and finally, a wide range of German government contributions to the value creation process are not disclosed by companies, with the exception of direct aid and subsidies, which are minimal, as you see here, only like 6.06 billion per year, I mean, for Bayer, and 0.01 billion for Merck. These include all non-monetary subsidies, but I mean, there are, of course, lots of other subsidies like infrastructure support, training of qualified personnel, and free or almost free access to the results of publicly funded research, which would otherwise be prohibitively expensive for corporations. But unfortunately, in our analysis, we can only show the direct subsidies as the contribution of the government to the value creation. And on the other side, we put the tax payments made as extraction. Over the period, the stakeholders eventually created more value than they extracted in total. Here 20 billion to 15 and 7 to 5. I mean, actually, these sources are allocated back to investments to finance capital expenditure, R&D, and mergers and acquisitions. But this table does not allow us to see whether there have been proportional changes in stakeholder kind of shares over the period. And this figure, you can show the evolution of the parts of the extraction of different stakeholders. But this downward trend in Bayer's share of employee compensation began to reverse from 2020 onwards, and dividend payments did not continue to increase despite the more shareholder-friendly rhetoric adopted at the time of the Monsanto acquisition. So, I mean, again, as I said, I mean, adopting this stakeholder model of corporate governance, we see that the strong stability of value distribution between different stakeholders. Yeah, I just now want to continue with the second paper and our second analysis, which extends the analysis of source and use of funds to the world's 27 largest pharma companies in terms of revenues. The data sample is made up of companies from various geographical regions, in particular the US and Europe, which make up the bulk of the sample, but there are also some other Asian companies. In this first figure, we show the trajectories of the categories of these companies' sources of funds, which are used to finance eventually uses of finance, productive or financial uses, activities. I mean, operating accounts for the largest share and continues to grow. The general increase in drug prices has contributed, of course, to the surge in this operating cash flow. The peak in 2020 onwards is due to the pandemic revenues, which dropped a little bit later in the last year. Debt trajectory fluctuates in relation to cash flow, but in an increasing trend. We see corporate borrowing rising sharply through 2009 and beyond 2010. Disposal and divestitures and share issues, they just contribute to a lesser extent to inflows. I mean, as a proportion, proportionally, as we see here, operating cash flow, I mean, like internally generated funds, is on average the main input variable, with a share of around 3/4 of total sources. As I said, I mean, total borrowings increase on average over the period observed, and this raises concerns about the financial stability of Big Pharma, an issue that we will just again develop later. I will show you. And as the total value of share sales and issues has remained constant over the years observed, their average share is rapidly falling, and cash flow generated via divestitures and disposals also fluctuate over the period. But when we go into details with each company, there are somehow major differences between companies when it comes to the weight of different sources. For some internally generated sources is the fundamental, like in the case of Astel last year, all blue, dark blue, or Chugai. I mean, these two Japanese companies, or even Novo Nordisk here. But some smaller companies rely heavily on borrowing, like Bausch or like Viatris, which accounts more than like half of their cash flows, cash inflows, I mean, which can also be observed in large companies like Takeda or Pfizer, mostly due to their heavy acquisitions that they funded via borrowing that I will show you later. And finally, equity issuance remains as a very kind of minor source of funds for companies, at least in some cases, in some smaller companies in their early years, like Regeneron or Vertex. Following the sources, I mean, this chart shows trends in different uses of funds over time this time. I mean, spending on R&D is still the main use of funds, reflecting the industry's still dependence on, of course, innovation. Cash trajectory and the preservation of the blockbuster model, especially, causes spikes in the trajectory. Debt repayments also rose just after the financial crisis, moderated later, but increased again towards the end of the 2010s and remained high. Dividends increased steadily, becoming eventually the second largest, so third largest category by 2023. Share buybacks have fluctuated, falling during the financial crisis, but recovering thereafter and peaking in 2018 before falling during the pandemic. And other variables such as capital expenditures, tax payments, and interest payments have seen lower growth, with interest payments seen a slower increase due to especially low interest rates during the last decade, I mean. Proportionally, the share of R&D expenditure in total uses has fallen since 2000. Together with capital expenditures, I mean, productive investment here refers to R&D plus capital expenditures, which now constitute only around third, like 35% of their overall uses of total funds. While financial uses, which is about like dividends, buybacks, interest payments, and debt repayments, are increasing. Mergers and acquisitions also like constitute around like 20%. And fiscal use is about tax payments, which fluctuates around 10% over the period. And this is the figure for each specific company. We see some cases that they initially used a significant proportion of their funds for R&D, like Regeneron, Vertex, Gilead, but some of them later shifted towards financial or external growth uses. But some others, they still just spend a high portion of their uses on R&D capex, like Chugay or still again to some extent Regeneron and Vertex. But there are also like companies which spend a lot on financial uses, like in the case of Amgen, and like also in the case of Novo Nordisk or Pfizer, etc. So overall, our analysis so far just revealed important insights into the resource allocation decisions of Big Pharma. We find that both operating cash flow and total borrowings are increasing in company's source of finance, squeezing out stock issuance and income generated via divestitures. In the case of users, we see increasing use of financial payouts and a decreasing trend in like productive investment. Then we just wanted to continue with further investigation of the reasons of external finance. I mean, reasons of the use of external finance. We know it in the literature, but the underlying reasons for the increase in the context of financialization are only partially analyzed. I mean, for debt and equity issuance into their categories of use. And here in this chart, you see the different ways in which borrowings are used. The two main issued to pay previous debt. Over 50% of corporate borrowing as a whole. If we assume that the other category, other borrowing, including general corporate purposes, is about like true investments, true productive uses, its share is decreasing rapidly over the years. And there is even a kind of share about 10% of borrowing used to fund buybacks and dividends, especially in the case of US corporations. I mean, is anyway just limited. We see again that a big chunk of like stock issuance actually comes from employees' payments to the company to exercise their stock options. I mean, it's not a kind of source coming from the new shareholders, but it is about the payments made by the company's employees to just exercise their stock options, and they will just go and sell their stocks on the market. So about like 3/4 of the use of proceeds of stock issuance comes from its own employees, and the remaining is about mostly about again debt repayment and acquisitions. So shows that 57% of Big Pharma's total funds are allocated to financial uses on average over the period, including those payments to shareholders, debt repayments, interest payments, and only like via R&D and capex, capital expenditures, and the remaining 10% is for tax payments. And as I showed you, I mean, in the previous chart, only like as a total contribution is only about 0.6% of the total. They add the life of a large company. Yeah, unfortunately, I mean, revealing the parasitic nature of finance that was coined by Veblen more than 100 years ago. This of the productive entity. And in contrast, close to 80% of the sources expressed in cash flows are generated by productive activity of companies in the form of cash flows and divestitures, disposals. Despite an increase in R&D spending, we show the decline in R&D in terms of its relative share. So it is important to note that in line with our political economy perspective, our methodology prioritizes the identification of case stakeholder groups and their involvement in the creation and use of company resources. As such, it gives us some advantage over existing aggregate macro or micro studies that focus exclusively on the relative change and extraction between primary groups without identifying their contributions. Our inclusion of the state as an important factor for both value creation and value extraction is important. Also, what is also important from a financialization perspective is that we highlight firms' priorities by comparing the contributions of different stakeholders to the value creation process. And from a stakeholder perspective, our analysis indicates that employees extract less than 60% of the cash flow generated by their own productive activity, while shareholders extract 3 to 4 times more than their contribution. Even in the case of these German companies, if we had these employee remuneration data of US companies, we could have had even a kind of sharper difference. And this undoubtedly proves the existence of a highly asymmetric relationship between the value created and the value extracted by different stakeholder groups. Finally, through our approach, we aim to help inform those with less traditional financial knowledge about the company's strategy and operations, but we want to present this information in a form that it is as free as possible from the main biases inherent in conventional financial reporting, and our approach contrasts with other financial measures used in macro studies. Even for leading companies in the sector, the stagnation of internal innovation has also influenced the need to strengthen their drug portfolios through M&As. And this regime of M&A, which has encouraged a radical expansion in the debt of Big Pharma over the years. Big Pharma uses debt to pay for acquisitions, but it also refinances its debt by issuing again new debt. And this will also just a problem when interest payments become higher, and then they have to even just pay more to financial actors. So in the case of Big Pharma, which still follow a strategy of maximization of shareholder value to a large extent, the viability, as I said, depends on the continued increase in public spending on R&D and healthcare funding, and consumer demand must continue for ever more expensive treatments just to continue this paradigm of shareholder value. Our methodology could help other researchers to base their criticism on empirical analysis, although we recognize the limitations of our approach that Pauline will just tell now. Yeah, thank you. Pauline, can you just unmute yourself?
Okay, sorry about that. Well, as Erdem said, there are various limitations to what we've done. I'm talking about the first part, some theoretical and some more practical. The first point is that value is not a static concept. As you can imagine, it's always been added to and destroyed, and not necessarily at the same rate, which means that empirical analysis is incomplete. Second thing to do with the data is that the cash flow accounts do remain more inadequate for trying to undertake a more complete value-based analysis. But as we've argued previously, we do think it's better in many respects than using income statement or balance sheet data that a lot of researchers do use. A third point is actually more theoretical as well, is that importantly, when we're looking at companies, pharma companies, whether largely domestically based or international, as we know from the massive comparative capitalisms literature, that the countries sort of operate under very different institutional frameworks in terms of funding, corporate governance, regulations, and so on. So that means that companies are quite likely to engage in institutional arbitrage, locating some parts of their activities to other more helpful regimes. So this, of course, makes comparability, even at a sector level, quite difficult, as Lever and Montalban have shown in their work. A final thing is that we haven't undertaken a discussion of executive compensation, which we argue will have strong linkages to what happens as regards financialisation. However, the good news is that the data is available and could be undertaken by other researchers. Thank you very much.
Thank you. Thank you very much, Pauline. And thank you very much for your attention.
Many thanks, Pauline and Erdem, for your presentation. Now, I've opened the floor for questioning, and please raise your hands or put the question in the chat, and I will pick it up. We can start. We can give people some more time to think about it. It's really fascinating presentation. If I use the word business model, then you can really highlight the challenges and issues with the business models of the big pharma. I just had two quick questions to start. Did you see any different behaviors from the firms based in Europe compared to the US and Japan? I mean, you had Takeda, you had big pharmas based in US and big pharma based in Europe. Were there any difference in terms of the use of them? And the second question about the big blockbuster model, I mean, that has been always been talked about as, under threat from last 20, 30 years. And we still continue to do, its existence, and followed by major pharma, some Ozempic comes and it gives no notice, a big boost, and suddenly you can see the reinforcement of those sort of a model. So the question is that what sort of things might wake up this big pharma and make the changes. I will also take the question from Maureen, and then you can answer all three together. Maureen, over to you. You are muted, Maureen. We can't hear you if you're asking the question. Maureen, we can't get your question. Your hands is up, and I guess your mic is on mute, so you might want to start the mic.
Yeah. Okay, I've done it. I thought you had to unmute me. I couldn't persuade it to unmute. Sorry. I've got two quick questions, and they relate to some of the question you asked, Dina, so it fits together quite well. One is about the 27 companies and which companies they include, because you're describing them as big pharma, and as Dina said, you're talking about sort of blockbuster models and so on. But at least one of them, I think, which is Teva, is basically a generics company. I see they're claiming that they're doing lots of R&D, but I don't actually think they are. So the kind of large companies are making quite a lot of money on the non-innovative stuff. So one question was, is this actually a mixture of traditional big pharma and something else? And the second one was whether there's no big Indian and Chinese companies in that list, I assume because they didn't come out as having a sufficiently large turnover or cash flow. But they are huge and highly influential in the whole pricing, cash flow issues. So I was wondering, and I've long wondered whether the rapid rise of the Chinese firms is in part maybe because they're not under the same kind of financialisation pressures. They have very different institutional support. But anyway, yes, so it's the mix of the firms you're talking about that I'm interested in and their strategies.
Erdem, you want to get this question first, and then we come back to Dave for his question in the next round?
As you like. I mean, I can just answer also to your question about the differences and about the technicalities. I mean, our second analysis is based on 27 pharma companies. I mean, pharma companies means that the majority of their revenue is coming from just the sale of therapeutic drugs, whether innovative or generic. Yes, we have Teva and also Viatris as like they're just mostly specialized in generics, but they also do a certain amount of R&D. And I mean, the classification is based on the revenue ranking as of 23. I mean, and we just didn't have time to just include 3 more companies to make the list to 30. And in that case, there will be 1 Chinese company also just entering in. And why we choose again another just categorization is about that all these companies are listed on the stock market since 2000. I mean, we have like a 24-year data of every single company. I mean, they are not just kind of entering in at some point. Yeah, there are more new companies like, for example, Moderna is not in the list. BioNTech is not on the list because they are just younger companies. There will be, but anyway, at least Chinese companies. And in terms of the use of debt, if there are any differences between, there are not many, there are not so big differences. I mean, the debt is really just very strongly associated to acquisitions. I mean, whichever company, Japanese or US or European, when they just go out for a big acquisitions, they immediately just go out for a big borrowing. One but interesting thing that we want also just analyze further, and we also saw that trend in the case of German companies that the share debt. I mean, if this is just kind of lower amount, which signifies that the company does not go out to further borrow and pay back its debt that it did anyway for acquisitions. I mean, in the case of German companies, the proportion of borrowing to pay the previous debt is much lower than the American companies, for example, because after a big acquisition, we see trends for like 5-10 more years. They keep just kind of recycling the debt, paying their debt. I mean, this will be a kind of differentiation between companies, but not the debt issuance. For in terms of like acquisitions, it's pretty much the same all over. And to your second question, maybe Pauline will also just say something, but we can also come back later. I mean, so kind of more about the overall picture. Yeah.
Okay, let's take the Dave's question and then Dave, over to you.
Hi. Sorry, are you waiting for me? No, it's Dave's question, right?
Hi. So really nice paper, excellent paper. Fantastic detail, which is really key. I had a couple of questions that I think they might be slightly off piece, but relevant, I think. One is the issue of what is R&D in this context. It's important, I think, because of the move from blockbuster to this mix of different types of innovation. Because a lot of the R&D, I think, that big pharma companies are doing these days is more D than R. Clinical trials, regulatory processes, this kind of thing. A lot of the pure R is being done by the smaller startup biotechs with huge public support that many people have found out, including Matsukato. So I wonder if you're able to untease a bit about the different styles of R&D in these companies, not just generics, but a lot of the big pharma companies have closed down their big R&D units, and they're really relying on buying up the small biotechs. And that links to the kind of second thing, which is around the nature of what biotech has done to drug therapy over time, whether you're able to untease a bit of that. Thanks.
Thanks, Dale. Let's take one more question from Rodion. Over to you.
Thank you very much. I'm from the Department of Accounting and Finance, so I'm very interested in this paper. My first comment is that obviously, well, the fact that issuing marketable debt, such as stocks and equity securities, is not the primary way in which businesses in general finance their operations, is not a particularly new finding. It's we've been sort of firms all over the world use banks more often than marketable debt to finance their activities. So off the top of my hand, I think the overall figure is probably 5 to 8% of sort of, I would expect on average, if you take a big sample. So 5 to 10 to 8% would be financed through equity shares, and the rest through debt. So if you could comment on that, because it's a long-standing, it's a long-known fact. And secondly, particularly in case with Bayer, we know that failed mergers and acquisitions, and with the probability of 50%, they're going to fail. Failed mergers and acquisitions, they hurt shareholders a lot. So in the case of Bayer, I think if you compare stock price, share price of Bayer pharmaceuticals, if you take the peak share prices that happened in 2015 or 2014, if I'm not mistaken, and compare them to now, shareholders lost a lot of money, a lot. So to what extent this is rent extraction if they lost a huge proportion of their funds as a result of this particularly bad managerial decision of the megalomaniac CEO, whereas over the same period of time, employees, because their rights are protected by law, they've been, year on year getting their salary and wages. So I would like, if you could comment on these two observations, please, if possible.
Thanks for that, Rodion. Over to Erdem and Pauline.
Thank you. Sorry, Erdem, do you want to comment on Dave Wheel's comment about what is R&D? I mean, I think it's a fair point, because it sounds from what you're saying as though companies are rather almost window dressing their financial statements to some extent to say, oh, this is all R&D, sort of, aren't we good? Whereas in fact they're sort of sidestepping the risk onto the real risk onto Bayer. Onto biotech. What do you think of that, Erdem?
Yeah, I mean, I agree. I mean, I agree with the overall kind of observation that, I mean, it's more about D, but unfortunately, I mean, we don't have data on this. I mean, companies do not publish detailed data about R&D expenditures. sometimes small, like very small biopharma companies, for a few years in their early years, they just provide more details in their annual reports, but later in time, they all disappear. I mean, unfortunately, we don't have the just correct numbers about that. I mean, but yeah, considering that the heavy procedures, bureaucracy, etc., all about like, especially like doing like phase 3, phase 4 trials, and we assume that it is a very big part of their R&D expenditures. And also, I mean, considering that the rise of this new small industry of like corporate research organizations, I mean that those contractors that they just do clinical trials on behalf of like pharmaceutical companies. I mean, their total overall revenue is also just mostly about like the deep part of the R&D. I mean, yeah, I'm totally agree, and and also there is some anecdotal evidence that big pharma companies here and there occasionally just closing down their research labs, ending their like basic research programs, etc. But we don't have any kind of systematic data to show this, unfortunately. Yeah. But I will also just answer to Rodion. I mean, is that okay?
Yes, okay.
Yeah, I mean, in your first comment about the 5 to 8%, I mean, in our sample, if we take only external finance, I mean, because we also have the internal finance as the cash flow and also divestitures. I mean, if we take only external finance, as I showed you, I mean, the contribution of shareholders is 0.5%, and the contribution of borrowing is 20% as the whole. So, I mean, if we take only the external finance, then 0.5 is around like 2.5 for the whole 100, and 505 becomes 2.5. So in this percent, and comment that this so like aim to just show in our paper this.
Erdem, you are breaking up. Can you, I don't know, with the mic. Yeah, can you? Yeah, fine now. Yeah.
Is it okay?
Yeah, fine. Yeah.
Contribution of shareholder to the value creation process. I mean, other side. Is it okay?
You are
Yes,
breaking in the
I
middle.
can hear you.
No, we couldn't. So we couldn't hear.
Is it about the sound? Can you hear now?
Yeah, we can hear you.
It's strange. I mean,
yeah.
I just wanted to say, I mean, this is the whole contribution of the shareholders to the value creation process. I mean, like 0.5% out of like 100%. I mean, and when they just complain about the decrease in the stock price and when they just lose revenue, I mean, first of all, the companies continue to distribute dividends. I mean, normally, I mean, they just still have access to those funds, and those dividends are again much higher, their contribution. And I mean, of course, stock price appreciation is not only about the corporate actions, it's also about the overall financial system. It's about the demand and supply. I mean, it's mostly about the demand on the stock market. And when they lose, maybe they lost because they just bought those shares when the prices were high. I mean, we cannot say that, I mean, stock market movements are exclusively just attached to the productive activities of corporations. I mean, there's so much speculation out there, plus some manipulation out there, especially in the case of US corporations with all sorts of executive pay and stock buybacks. So, I mean, in our case, I showed buyer, I mean, buyers, we just even have data before 2000. I mean, the overall contribution of shareholders by buying shares directly from the corporation and paying to the corporation is almost nil compared to how much they extract through dividends. I mean, and in the US companies add up buybacks and even reduce shareholder contribution, because even that is much smaller. Yeah. Thank you.
Pauline, you want to add something or?
No, that's fine.
Okay.
Thank you.
Rodian, you have any follow-up question or you're okay with?
Yes, thank you very much, Mustafa, for your answer. The amount of, well, yes, markets are not efficient, are not fully efficient. But here in this particular case, I suspect that the markets sort of were roughly right by guessing that the specific business decision of the buyer CEO was so bad that they tanked, the share price tanked. And so it lost, I don't know, 80% of market value, or maybe more, over the past 10 years. And so, to what extent, what it means is that it's basically shareholder value is very, very risky. And so,
yeah,
shareholders, the financial theory tells us that the shareholders have, in parts, get these dividends to be protected from that risk, in parts. And if we stop paying dividends to shareholders, and some companies have not paid shareholders for very, very long time, such as Netflix, for example, haven't paid for many years. To what extent shareholders will be interested to support our companies?
That's yeah, you reply, and that will be the, if anyone has one more question, if not, that will be the last question, and then we'll close. Okay, over to you, Erdem.
Yeah, again, exactly. I mean, what we are just trying to show that from your last word, shareholders are not contributing anyway, anyhow, to corporations. I mean, maybe in their early years, startup years, yes, there is some contribution. I mean, there is some also risk taken. But when we are talking about going concerns like these large corporations, I mean, their contribution, in our case, I mean, we define value creation as what input you bring to the company, directly to the doors of the company. I mean, shareholders bringing nothing, almost nothing. I mean, just very nil, 0.5% as the whole. I mean, so they should, I mean, know this fact first, those shareholders, when they are just buying shares on the stock market, that they are not bringing anything to the process, to the value creation process. When buyers' shares tanked, buyers didn't just lose innovative studies, didn't just lose its productive power, capabilities, workforce, and everything. I mean, it just keeps going on. I mean, Bayer just becomes an unlisted company today. It can just continue, I mean, create value through the contributions of true productive actors. I mean, this is the thing. I mean, we are just claiming that this idea of investors, I mean, they are not investing. I mean, they are just going to stock market and buying and selling those stocks between themselves. Yes, of course. I mean, there are corporate decisions, and they have impact on the shareholder behavior. And yeah, there should be some sort of prudence, both from the corporate side and the shareholder side. But again, I mean, there is this dividend format, which over the, for example, period of the golden age was about like 25% of the profits for entire 30 years in the 50s, 60s, 70s. Everyone was pretty happy about that. Everyone was content. No one was complaining. But the 80s came, and now even more than 100% American companies sometimes distributing, and they are still complaining, those shareholders, I mean, those investors, I mean.
Thanks a lot, Erdem, Pauline, Leonhard, for your contribution, presentation, and accepting the invitation and giving a fascinating seminar. I also thank all the attendings, all the participants for the interesting conversation and being here and supporting the iKid seminar series.